Hello. I know a lot of you are used to us delivering really good content to you about the year ahead, more toward the beginning of the year. Obviously, it's a little bit later in the year right now. Here we are in March. A lot has happened since we've created this video, but we firmly believe that what we see as far as trends, as far as our outlook, hasn't changed at this point. So please watch, enjoy, and give us feedback. Thank you.
Hello, friends, and welcome to our Schulfer and Associates Wealth Management presentation of the 2025 Economic and Market Outlook with information from the LPL Research team of experts. First, I'm going to take a few minutes and just remind you a little bit about who we are. Then we'll get into a recap of what our 2024 predictions were, what were our hits and what were our misses. In a bit, the other wealth management advisors from our firm, Jim Robinson and Jean Schulfer, will join me for our 2025 Outlook, where we will discuss our views based upon LPL research of what we believe the economy and financial markets may likely bring forth for investors. Jim will recap our presentation and he'll leave you with some important reminders. Schulfer and Associates Wealth Management is a boutique independent wealth management firm located in beautiful downtown Stevens Point, Wisconsin. Independent means that we are not employees and we are not directed by a parent company like an insurance company or a bank or a wirehouse. We are not subject to corporate canned mission statements. We are not subject to quotas where we have to meet sales of certain investments, nor are there mandates for what we must do. Rather, independence means that our growing team serves our clients as we best see fit. We are affiliated with, but not employed by, LPL Financial, so that we may utilize expert resources such as LPL's research team and so much more. In a nutshell, we create lifetime relationships with our clients to help them through important financial decisions as they arise, with financial and retirement planning, and of course, investment management. And that's the part that we're going to focus on today, the investment component. So let's take a quick look back at 2024, evaluating the stock and the bond markets, the predictions of what we made last year, what we got right, and also review what wasn't quite right and what we can learn from. If you wish to dig into the details, a full write-up is available on our website at schulferandassociates.com on the Resources tab under Useful Links. All right, let's evaluate the stock and bond market predictions that we had based upon LPL research from 2024. Perhaps the most impactful decision that we had made was to recommend that investors stay invested in equities at benchmark levels throughout the entire year, despite worries that we faced, including worries of a pullback and volatility surrounding the election. Our tactical recommendation was to stay neutral to the benchmark. And now that may seem like a miss since equities did so well, because of course an overweight would have been better. Wall Street price targets, including ours, called for single-digit returns in equities. A downgrade was tempting given the magnitude of the gains and the narrow leadership and, of course, the rich valuations. So as we know now, stocks defied the skeptics and they just kept marching higher in 2024, almost without interruption. The maximum drawdown that we saw in 2024 was in August, and that reached a low of 8.5%. With the benefit of hindsight, this would have been an opportune time to dial up equity market risk to overweight, a profitable trade that we had actually contemplated but ultimately missed. The swift recovery into September also caught us off guard, but fortunately, and despite some technical damage and political uncertainty, we at least did not turn negative in our exposure to equity markets. How about fixed income? What we got right and what we got wrong. It was arguably a disappointing year for high-quality fixed income markets based upon the Bloomberg Aggregate Bond Index's performance. Investors should reasonably expect to receive coupon income each year, which they in fact did, but that was largely offset by the move higher in interest rates. It was a volatile year for interest rates, with the 10-year trading between 3.62% and 4.71%, and the 2-year trading between 3.5% and 5.04%. Ever-evolving Federal Reserve rate cut expectations were the primary drivers of volatility, where concerns about ongoing fiscal budget deficits and Treasury supply had added to the elevated rate moves. But the winning call for fixed income was to strongly overweight the preferred security asset class, which turned out to be the best performing major asset class sector within fixed income in 2024. In terms of misses last year, we underestimated the ongoing resilience in corporate credit markets, both investment grade and in high yield. Our economic call for most of the year was for the U.S. economy to slow down, and that never really happened. So positive economic conditions had allowed credit markets to remain expensive, while our recommendation to invest in the short to intermediate parts of the investment grade corporate credit spaces worked. That part of the credit curve had actually outperformed the broad index by nearly 3% in 2024. Our decision to underweight the sector broadly was wrong, although we used the underweight to fund the preferred allocation. So that wasn't so bad. Also, not enough high yield. The decision not to invest in high yield bonds was also a bit of a miss. High yield bonds and loans were up over 8% in the year, and then the spreads had remained relatively contained. We were waiting for the spreads to widen to change our recommendation, but that never had happened. So there you have it. Those were our hits and our misses for 2024. We're pleased to report more hits than misses. We got more right than we have missed, and we're hard at work trying to deliver more for 2025. So let's transition over to our outlook. What is your outlook for 2025? Well, let's dive into ours. Starting with the economy, where we see the consumer slowing, but policy tailwinds are expected to help the economy this year. In 2024, business owners said that they were waiting to ramp up the spending of what is referred to as CapEx, which means capital expenditures, until after the election. The market seems ripe for a resurgence of that CapEx spending in 2025. This slide shows the percentage of intellectual property products as a percentage of GDP, or gross domestic product. Remember, gross domestic product is the measure of all goods and services produced within the United States. As you can see from this chart, the percentage of R&D relative to GDP has risen significantly in the past few years, as we believe we are set for another resurgence in the spending. To further add to the research and development spending, the demand for power and communication structures are also on the rise. So is equipment spending, slated to increase. So all of this suggests an upside to business spending in 2025, which will be positive for the economy. Demographics will likely be a tailwind to growth in the coming years as well. It's probably no surprise to you when we say that peak spending comes from 25 to 54-year-olds. And guess what? Millennials, which is that generation of people who were born from the early 1980s through the late 1990s, are just about to begin their peak earning and their peak spending years. Millennials make up a very meaningful percentage of our overall population, so economically speaking, this is good news. Their spending will be impactful to our economy. Because of the amount of households who had refinanced their mortgage debt in 2021 when interest rates were very low, and because of the rise in real disposable income from a tight labor market, we should see some continued strength in consumer spending. In fact, by the time we approach 2030, about 75% of the labor force will be millennials. Additionally, outside of the raw economic forces giving the economy a demographic tailwind, the greatest intergenerational transfer of wealth is about to start, and millennials and those younger will be the benefactors. That will further strengthen the consumer in their peak spending years. All good news for the economy. In addition to age bands, we also look at income bands and their impacts on the economy. It's no surprise that higher income households are the ones who are driving consumer spending. And incidentally, we're also the ones that were least impacted by pandemic-induced increases in rental prices for housing. Upper income households are also the ones who will be least impacted by tariffs, according to research surrounding the Trump-Biden tariffs. So the key point here is that investors need to watch what the upper income consumers are doing, where they're spending their money, how they're managing their expenses, because that will be the leading indicator for the rest of consumer metrics. This chart shows the pace of inflation looking all the way back to 2017. Here, you see inflation behaving rationally until the pandemic. The spike then in inflation was due to several factors of the pandemic. In 2022, we began to see the deceleration of the pace of inflation. However, we will say that although inflation is decelerating, the pace of deceleration is not nearly as fast as what the Federal Reserve would like to see. Barring any supply chain shocks or any extreme tariff policies, we don't expect inflation to re-accelerate. But the path to the 2%, which is what the Federal Reserve's target is slow and it is arduous. Complicating things even more is the stickiness of what we call the owner's equivalent rent, or OER. That's an imputed cost. It's not an actual cost, but it affects people's pocketbooks. Other sticky components to inflation are things like medical care and insurance. These are examples of what has kept inflation rates elevated. The slow and sluggish path to the Fed's target of 2% means that the Fed will likely take a cut and pause cadence in 2025, possibly with a total of 4 25 basis point cuts throughout the year. All right, I'm going to hand it off to Jim. Jim, please go ahead and tell us about the outlook for stocks and bonds.
The bull market has entered its third year, having celebrated the second anniversary on October 12th, 2024. The S&P 500 is up nearly 70% since the move began, with a booming year two followed by a below average but respectable year one. A surprisingly resilient economy, unwavering trends in technology, moderating inflation, the start of the Fed's rate cutting cycle, and a strong earnings recovery after the earnings recession ended in 2023 have driven much of the gains. History suggests that this bull market has a good chance to celebrate its third anniversary. In the absence of recession, the odds that a two-year-old bull market gets to year three are solid. For bull markets that get through year three, the average gain for the S&P 500 is 5.2%, with 6 positive years out of 8. The bulls that didn't make it through year three were ended by recessions, an overly aggressive Fed, or, in the case of 1987, excessive speculation. We believe the chances of another positive year in 2025 without the start of a bear market decline are quite good, but history tells us to expect modest gains. Longer term, the history of bull markets offers cause for optimism. Since 1950, excluding the current period, S&P 500 bull markets have averaged 61 months and have produced average cumulative gains of 167%. In other words, while volatility along the way is to be expected, the bull market still could have legs. After one of its longest pauses in history, the Fed cut interest rates in September and November. Now the question is how much support additional cuts may provide for stocks in the year ahead. Based on the last 9 major rate hiking cycles since the 1970s, the S&P 500 has generated relatively modest average returns of 5.5% during the 12 months following the initial cut of a cycle. Taking out the recession-plagued outliers of 2001, 2007, and 2020, the median gain has been 10.8%. Prospects for solid returns in 2025 are favorable if the economy avoids recession. That does not, however, mean we should not expect volatility. In fact, even in non-recession periods of 1984, 1989, and 1995, the S&P 500 experienced pullbacks of between 5 and 10% along the way to double-digit 12-month returns after the initial Fed cut. The earnings growth picture is much improved from a year ago. In the past year, stocks went from an earnings recession and widespread recession fears to a now widely held consensus view that the U.S. economy would continue to grow steadily, though perhaps at a slower pace than recent trends, and that corporate profits would grow double digits. In response to improved corporate profit trends, LPL Research is maintaining its S&P 500 earnings per share or EPS forecast for 2025 at $260, in line with the long-term average earnings growth rate near 10%. For 2026, LPL Research is initiating a 2026 S&P 500 EPS forecast of $275, 6% above 2025. Broadly, corporate America will get some help from AI investments and related productivity gains. The Magnificent Seven are expected to grow earnings by an average of 17% in 2025. Banks and energy companies should benefit from deregulation in Washington, D.C. However, potentially slower economic growth, the potential for rising borrowing costs, and tariffs are among reasons to expect modest earnings in 2026. Cuts to corporate taxes also offer potential upside. With positive sentiment at record extremes by some measures, risks may be growing for a near-term correction. In fact, U.S. households are as confident as they have ever been that stocks will move higher in the year ahead, though some sentiment readings, such as those taken from the options market, are more subdued. Any signs of exuberance call for discipline. Current market pricing suggests the Fed will take the Fed funds rate back to around 3.5 to 3.75% in 2025. If markets are right and the U.S. Treasury yield curve eventually reflects its historical upward sloping shape, that likely means the 10-year yield should remain around current levels. The spread between the Fed funds rate and the 10-year Treasury yield has averaged around 1.1% in non-recession periods, meaning the 10-year yield on average has been higher than the Fed funds rate by around 1.1%, albeit with a large range when not in a recession. So unless or until economic data starts to show signs of sustained slowdown, the 10-year could fluctuate between 4 and 4.5% to start 2025. But if the economy does show signs of slowing, the Fed could cut rates more than what is priced in, which would mean the 10-year Treasury yield could get back into the 3.75 to 4.25% range to end the year, which is our expectation. The Treasury term premium is the additional compensation required by investors who buy longer-term Treasury securities. The term premium, which is unobservable and hence must be approximated, considers a variety of factors, including Treasury supply-demand dynamics, foreign central bank expectations, and the possibility of future inflationary pressures. And after years of a negative term premium, investors are just now getting compensated for owning longer maturity Treasury securities. But that additional compensation is still below longer-term averages. So how does this affect fixed income investors? Well, positive term premium could keep longer-term interest rates elevated, perhaps reducing the diversification benefits of core bonds. Regarding the former, while monetary policy expectations will continue to be the dominant driver of interest rate changes, Fed rate cuts may not have the desired effect, and the longer-term interest rates may not fall as much as they would have without a positive term premium like we've seen recently. In terms of the latter, while we still believe Treasury securities will be the safe haven choice in the case of a broad macro equity market sell-off, they may not be the best defensive option for a garden variety equity market sell-off. While economic growth will remain the driver of interest rates, a secondary risk to rates remains the amount of Treasury debt needed to fill federal budget deficits that are expected to stay elevated. Per the Congressional Budget Office, CBO, the U.S. government is expected to run sizable deficits over the next decade, to the tune of 5 to 7% of gross domestic product, or GDP, each year. And to fill those deficits, the Treasury Department will need to issue trillions more in Treasury securities. But complicating the math for the Treasury Department will also need to roll over more than $6 trillion in Treasury securities set to mature in 2025. Thus, the Treasury will need to find investors for some $8 trillion of Treasury debt over the next 12 months. But despite the mountain of debt and growing interest payments, the U.S. government is not at risk of financial collapse, nor are there concerns as such. As long as treasuries are considered risk-free securities, there will always be buyers of treasuries, full stop. But with a Republican sweep of Congress and the White House, the deficit will likely remain broadly unchanged at elevated levels in the coming years, or perhaps even grow given what we know so far about Trump policy proposals. And with the amount of treasury supply, interest rates may need to stay higher than otherwise expected, given economic data alone. I'm going to now pass it over to Gene, who's going to address a number of other things we should pay attention to.
Hello, everyone. I'm going to cover a few other areas that we will be watching as the year develops. Alternative investments may provide opportunities to capitalize on changing market conditions. We expect lower rates and shifts in political policies would be key drivers of the market for 2025. Uncertainty surrounding the new Trump administration's policies may lead to increased market volatility and divergences between individual stocks and sectors versus the broader market. We've seen the expectation of divergence materializing last year, and we expect this to continue in 2025 as market participants digest these changes and subsequently begin to distinguish between stocks that are positively and negatively impacted. Strong fundamental, long, short, and market neutral stock pickers should benefit and should become increasingly attractive. Multi-strategy funds have delivered strong, risk-adjusted returns over time with low correlation to traditional markets, and we believe they should be one of the key components to any alternative investment allocation. Geopolitics can be thought of as an international chessboard. The good news is that markets have successfully navigated a series of high-risk scenarios throughout history. Even significant market downturns caused by recessions, exogenous shocks such as the COVID-19 pandemic, or liquidity meltdowns have ultimately led to stronger, more resilient markets with more attractive valuations. A key question recently has been, are commodities due for an uptick or a supercycle? One of the most significant commodity supercycles is closely associated with China's massive infrastructure build-out in the mid to late 2000s, as seen in the orange line of this chart of the Bloomberg Commodity Index prices. Expectations for another supercycle have been thwarted by slower Chinese economic growth and more specific global construction projects rather than the massive and unbridled expansion underpinning China's double-digit development. When it comes to currencies, the dollar continues to reign across global markets. Solid economic growth, especially compared to other developed countries, has been a major driver of strength and stability in the greenback. Developing uncertainty over the trajectory of inflation, expectations for gradual easing from the Fed, and positive interest rate differentials have further supported the dollar. President-elect Trump's proposed tariffs could elevate currency market volatility and stoke inflation fears, putting additional upward pressure on the dollar. Based on this backdrop, we believe the dollar will be well supported in 2025. We expect limited downside risk, while meaningful upside could be capped by the gravitational pull of Fed easing. From a technical perspective, the US dollar index has been contained within a range over the last 2 years, marked by support near 100 and resistance around 107. And while the recent upward momentum could push the dollar into the upper end of that range, a breakout appears unlikely given the Fed's rate cutting cycle will likely continue through 2025. Thank you, for taking the time to learn about our outlook for the year ahead.
So let's do a quick recap. While consumer spending may slow down this year, we could see business spending pick up. As far as stocks, history suggests that we could have a third consecutive bull market. But don't expect broad, smooth sailing. There will be winners and losers. Bonds are behaving more like bonds, like the bonds of old, where they can have a place in a balanced portfolio. And while it's expected that Treasury debt goes up, there are not concerns of financial collapse. And finally, we believe that there could be a stable U.S. dollar this year.
Thank you for joining us for our Outlook 2025. Our growing team at Schulfer and Associates Wealth Management is delighted to help you through important financial decisions as they arise, with ongoing financial and retirement planning, and of course, with investment management. Please reach out to us on the web at schulferandassociates.com. You can visit us on Facebook. Give us a call at 715-343-9600 or stop by at 1417 Main Street, beautiful downtown Stevens Point. We wish you a safe, healthy, happy, and prosperous 2025.
Hey, thanks again for watching our Outlook for 2025. And if you'd like to continue to keep up with things in the news that are related to your investments and your planning, we have a couple of ways for you to get that information. First, if you haven't, please make sure you've signed up for our weekly newsletter email. As you can see in some of the illustrations here, we have a weekly market commentary from LPL Financial Research, an article by Luann, a video by myself, or maybe get to know us a little better by seeing some of the fun stuff that we've been doing. And don't forget about our website at www.schulferandassociates.com. A great place to not only access your information if you're a client, but look up our resources, learn more about us, see if maybe you or someone you know is a good fit. So again, if you want to stay tuned, stay connected, please make sure you've signed up for our weekly email newsletter, and we encourage you to visit our website for an awful lot of content to keep you up to date. Thank you. And for those of you who like to stay to the end of the movie and watch all the credits, you're in luck. We've got some great disclosures for you to review. Thanks again.